The dividend rates I'm about to show you are up more than 4 and outperform the market by 14. This is true even if the overall real estate trust companies are down 12 so far this year. These rates give you the chance to diversify your investments away from stocks in addition to providing a strong dividend cash flow and upside potential. I'll discuss the 5 finest dividend rates to look out for in this video, including the one that every investor ought to be purchasing. Which stock from the several themes would you choose to invest in if you could only pick one? By the end of the series, you'll have a portfolio of the top companies to buy because we'll cover all the strategies, from value to growth bonds and tech stocks. More crucial than most investors understand, we're entering a brand new asset class. I'll explain why that is later, along with what to look for in these real estate stocks and the ideal rate for your portfolio, before getting into our list of dividend rates. The first rate on our list is Gaming and Leisure Properties, ticker GLPI, which I have been keeping an eye on closely this year. The company has 52 properties across 17 states with a 5.4 dividend yield, many of which are 60 miles or more from any competitors. With gaming and more than 15,000 hotel rooms, its casinos are run by some of the greatest names, including Caesars, Boyd, and Penn National. Besides that, growth in gambling that we're just starting to witness around the United States. I absolutely enjoy this company's business model because casinos pay all costs, including maintenance, by entering into triple net contracts with operators. Strong contract provisions have allowed GLPI to maintain 100% occupancy from the company's founding. We all know that the pandemic had a significant impact on this sort of property, but free cash flow is already rising. Over the past year, the corporation earned free cash flow of $728 million, almost twice as much as the $424 million in 2020 and prior to the epidemic. Now that the casino players and weaker rates in this sector have been eliminated by the pandemic, leaders like GLPI have gained market share and have grown stronger. In addition to offering a high dividend yield, the company's shares have outperformed the market this year by nearly 20. I also really like the company's growth story. We're just getting started, but if you watch a video on dividend rates, I feel like you already know why you should invest in these. Maybe I'm prejudiced because my first internship was as a commercial real estate analyst, but no other investment has produced as much legacy wealth as real estate. We'll look at a technique to mitigate some of the dangers associated with stocks, as well as how real estate offers some of the highest profits. Rates are a simple way to invest trading like stocks without having to put down the tens of thousands required for a down payment. The amount of safety and income flow you desire will largely determine how much you should put in dividend rates. I would recommend investing at least 10 to 15% of your wealth, or even more if you desire additional income flow, in real estate or rates in order to slightly further diversify your stock portfolio. While younger investors who want higher growth might allocate a little bit less money to rates, you might go as high as 25 or 30%. I like being able to add that mortgage component to the list because Blackstone Mortgage Trust, symbol BXMT, is one of the few mortgage rates to be holding up really well this year. Remember that mortgage rates borrow money at such short-term rates, and then leverage it up to 3 or 4 times higher with debt to invest in mortgages rather than directly owning property like typical real estate investment trusts. Because of this leverage, mortgage rates can provide enough cash flow to pay a greater dividend even though the mortgages may only have a 3 or 4% interest rate. The rate has 157 loans on a portfolio of $22 billion, and it just originated $4.7 billion in loans. Thus, it is continually increasing and that dividend is fully covered by the earnings. This is similar to Blackstone's 8.2 yield. Approximately 29 of the portfolio's loans are for office space, making up little under half of the total, while the other third is spread among different property types throughout the US and even in Europe, providing some diversification. This year's mortgage rates have been impacted since new loans with higher interest rates are worth less to investors than existing loans. As rates rise and home buyers are pinched, mortgage demand has also decreased. It is possible that things will get worse before they get better, and we are already seeing some of the smaller mortgage providers go out of business. Blackstone Mortgage, however, has the liquidity of a massive investment behemoth behind them and is well capitalized. Blackstone performed well throughout the pandemic, with the portfolio's loan-to-value never going beyond 66. So this is really high-quality real estate, and it has steadily improved earnings. The company trades for a relatively low price of 1.1 times book value. And even though the shares are slightly down year over year, it is still beating the market as a whole and generating that positive return. If you're searching for greater yields but are concerned about some of the weaker players in that mortgage rate, this is an excellent option to take into account once you factor in the 8 dividend yield. Although Space Realty Income, symbol O, isn't the stock with the best dividend on the list, it is quite well known for its monthly payout, so I decided to include it. The only REIT on the list of dividend aristocrats that has seen annual dividend increases since 1994 is Realty Income. In fact, it has a double-digit shareholder return over 30 years and a dividend rise of 4.4 annually. The company has nearly 11,000 properties in the retail sector. So a decline in consumer spending or a recession will cause some weakness. However, these properties span every sector of the retail sector, including grocery, convenience, dollar, and restaurants. A lot of these industries have more steady cash flows than typical cyclical retailers, like fashion or electronics, in addition to the fact that you have decent diversity. With 225 properties in the UK and Spain, Realty Income has recently begun to expand internationally. Since consumer spending will likely decline in Europe due to higher inflation, this portion of the portfolio accounts for less than 2% of the company's total property, so it won't significantly affect the stock price. Moreover, I like the idea of future global expansion. This is another rate using the triple net lease method, which results in lower operational expenses for the rate and long-term leases that provide stable cash flow. The average lease period is 9 years. Realty Income has been able to keep its occupancy rate at 98%, which is more than 4% higher than the national average, demonstrating the care with which it approaches leasing. Even while this dividend is less than others on the list at just 4%, it is paid out monthly, which is preferred by many investors, and shares have outperformed the market this year by more than 12%. Let me know in the comments if you have any other questions about investing. Let's return to the video. The Investo Equal Weight Real Estate ETF, symbol EWER, and the Invesco Premium Yield Rate, ticker KBWI, both have excellent yields of 5.5 and 2.6, respectively, and are the following items on our list of dividend rates. Although they haven't performed quite as well as the individual rates on the list because they are funds, you can instantly diversify your portfolio across several property kinds. For instance, the KWI invests in small and mid-sized rates and contains some of my favorites, like GLPI, Gladstone Commercial, and Omega Healthcare. Therefore, in addition to the robust 5.5 dividend yield, you also have some possibility for growth on the smaller rates and stability across a variety of property types. The Equal Weight Fund, which includes outstanding names like Duke Realty, Extra space storage and Prologis contains a greater percentage of these higher-rated businesses and provides even superior diversity. In order to spread your investment across a variety of property kinds, you can think about choosing one or two of the specific REITs you truly like and investing a portion of your funds in these ETFs as well. With a loss of 6.8, the KBWI has outperformed so far this year. Yet it is still performing better than the stocks in the S&P 500. Although it has performed similarly to the market, the equal weight rate nevertheless offers a higher dividend. We'll get back to our list right away, but before we do, allow me to explain what to look for in some of these REIT stocks and how to choose which is ideal for your portfolio. We've already discussed some of that analysis on the channel, including metrics like funds from operations, but in this post, I want to give you a broader perspective. The first thing you should check is what kind of property the REIT purchases. The same is true for data centers, warehouses, self-storage units, and office buildings, which is necessary because most REITs only focused on a single property kind. So you really need to have a positive attitude on that one or to diversify your portfolio holdings. Next, you should consider the REIT's investment locations. Perhaps if the majority of them will be centered on the U.S. real estate market, it still helps to discover one with real estate spread out across a region or even the country. It's crucial because a REIT with assets spread across a small number of states could suffer if the country's economy falters or a natural disaster strikes. Another crucial element is tenant diversity, and information on each of them may be found on a REIT's investor relations page. You only need to enter the firm name and investor relations into Google to find this. You can find a company presentation and other documents that detail the different kinds of properties, tenants, and financial information. The concept of tenant diversification is crucial because in the event that one renter defaults, you don't want any one customer to account for more than 10% of your REIT's business. Here is a breakdown of real estate income. As you can see, even at Walgreens, the percentage of total rent is only 4%. The breakdown is also broken down by state and business type. The occupancy rate for the properties as well as a historical rate are both included in this investor presentation. Of course, the greater the better, but stability and occupancy are more crucial. It's excellent if occupancy can be over the average occupancy of 94 in those huge REITs. And you don't want to see any significant reductions that would indicate weakness in managing the properties. I also want to share a tool for tracking REIT stocks before we return to our list. You may see the performance of the National Association of REITs by looking up terms like NAY REITs, NAREIT property returns, or returns by property on Google. You can download the data in Excel, but I found that browsing the online version is a terrific way to follow the returns for each type of property. The returns and the perspective on one property type can be very different from those on others. So you really need to think at this in terms of not just all REITs combined, but also the property kinds you like and the companies within each. You can see how this can help guide your investment by looking at the report, where you can see that all equity REITs have experienced an average decline of 12.2% so far this year, with regional malls experiencing a decline of 30% and, more modestly, Safer Healthcare experiencing a decline of 4.6%. Self-storage REITs increased 79% last year, and I previously advised investors to stay away from this market because of its high valuations. Here we can see that they are down by double digits. Despite this, I continue to favor healthcare on the long-term trend because despite the slight loss, it has protected your portfolio from the worst stock market performance as well as some of these other property types. Before I reveal the best dividend rate to buy, I would also like your opinion on this. Which REIT property kind is your favorite? Or which stock from the list do you prefer the most? Please tell me in the comments. Perhaps not for the reason you're thinking, but WP Carry, ticker WPC, has my highest dividend yield at 4.8%. A WPC is a 17 billion REIT with significant property type diversification. The distribution of industrial, warehouse, office, and retail space is actually rather equitable. The majority of the portfolio is in the United States, but it also owns 35 buildings in Europe, giving us excellent geographical diversification as well. This diversification is the main reason I favor WP Carry, for its top dividend yield. All 5 of these REITs are solid businesses that pay out fantastic returns and make terrific investments. But if you're just buying one in the sector, you really need the variety of property types that WPC provides. Only casinos are available through GLPI, only retail is available through Realty Income, and only mortgages are available through Blackstone. But with WPC, the company generates over $1.1 billion in annual base rent, booking 98 occupancy over 131 million square feet across more than 1,000 locations, and does so while diversifying internationally. Over the past 4 quarters, WP Carry has exceeded estimates for funds from operations, reporting an FFO of $5.33 over the previous year, trading at under 16 times price to FFO, which is a great value compared to the average rate of 18 times. And the shares have performed admirably this year, returning 7% more than that dividend yield and outperforming the market by 17%. Hence, a very strong performance. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button, and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.